Ever feel like you're trying to drink from a fire hose when it comes to staying informed? Articles, reports, research. It's a lot.
Oh, definitely.
We're all looking for that shortcut, aren't we? That direct line to the key insights without getting totally swamped.
Yeah, a way to get the signal from the noise.
Well, today we're diving deep into exactly that kind of shortcut for strategic thinking. It's called the Boston designed to help businesses and, honestly, anyone trying to make smart calls, figure out where their products or services or even whole business units kind of stand in the market.
Right, and crucially, where they should focus their energy, their resources for profit.
Exactly. It's especially useful, I gather, for companies that are juggling, lots of different markets or products.
Yeah, when things get complex.
So our mission on this deep dive is not just to define it, but to really unpack it, explore its 4 quadrants, see how it's used, and also, critically, look at its strengths and maybe surprisingly, its common pitfalls. So by the end, you'll have a really sharp, well-rounded grasp of this classic business tool that still shapes decisions today.
What's always struck me about the BCG Matrix is its enduring simplicity. At its heart, it's just a visual framework.
Okay.
It helps leaders quickly get a handle on the strategic position of whatever they're offering. Think of it like a simplified map for your business portfolio.
A map. I like that. A map guiding investment, you said.
Exactly. But like any good map, it needs coordinates.
Right. So what are the 2 fundamental axes here? What anchors this matrix?
Okay, so the matrix uses 2 critical dimensions to plot your offerings. The first one is relative market share.
Relative market share.
Now, this isn't just about how big you are overall, it's how big you are compared to your closest competitor.
Okay. So it's about the competition.
Precisely. If you're the leader, you measure against the number 2 player. But if you're, say, number 3 or 4, you're sizing yourself up against the dominant leader.
So it immediately tells you if you're setting the pace or following it. Market maker versus market taker.
Got it. It's about that competitive clout.
Okay, so competitive dominance. What's the second axis then?
The second axis is the market growth rate. This basically tells you if the whole market itself is, expanding rapidly, or if it's more mature, maybe slow growing, or even stagnant.
Gotcha. Fast lane or slow lane for the industry itself.
Exactly. And plotting your products or services based on those 2 factors, your competitive strength and the market speed, gives you that immediate snapshot of their strategic position.
Okay, let's unpack this then. So we've got these 2 axes, market dominance versus market dynamism. Once we plot things, what do these quadrants actually reveal about a product or a business? Let's maybe imagine a fictional company, call it Peak Ventures.
Good idea.
Say Peak Ventures has a mix of stuff, some cutting-edge tech, some really established services. How would this matrix help them?
Well, what's really insightful is how each quadrant paints a very specific picture for Peak Ventures. And each has totally distinct implications for, strategy, investment, the whole deal. Let's start with maybe the trickiest one, the problem children.
Problem children, okay. Sometimes called question marks too, right?
That's right, question marks. So what are their characteristics for Peak Ventures? Are these their new, maybe unproven ventures?
Yeah, like maybe a brand new AI app they're experimenting with.
Exactly. Problem children are those things with relatively low market share, but they're in a fast-growing market.
Yeah.
So that AI app is a perfect example.
Yeah.
They're often pretty novel, haven't really gained traction yet.
Yeah.
Financially, the gross margins might look okay on paper, but the overheads are typically sky high. You're pouring money into R&D, advertising, just educating the market sometimes. And you don't have economies of scale yet.
Right. So they often lose money at the start.
Very often, yes.
Yeah.
Initially, loss-making is common.
So, okay, if you've ever launched something new, you know this feeling, right? That problem child phase, it's exciting, but also terrifying. High hopes, burning cash, every decision feels huge. How does Peak Ventures decide which of these to double down on?
Well, you've hit the nail on the head. To realize their potential, Peak Ventures needs really prudent development, sound project management. They need to avoid what our sources call costly disaster.
Costly disasters, yeah, I can imagine.
And the tough truth is, many problem children, unfortunately, they never really escape this quadrant. They either stay stuck or they eventually slide down into becoming dogs. So the real challenge here for Peak Ventures is picking out which of these promising but really cash-hungry ventures actually has the potential to become, well, the next star.
All right, so that's the hopeful but pretty precarious start. What about that next stage, the one everyone dreams of hitting, the stars?
Okay, so if problem children are the unpredictable seedlings, what happens when one really takes root and starts, flourishing? That's where you find the stars.
Okay.
These are your products or services with high market share, and they're in a fast-growing market. So for peak ventures, maybe this is their popular new subscription service that's just killing it in its niche.
Right. Demand is strong. Competitors haven't quite caught up yet.
Exactly. Market saturation isn't really an issue yet, so they often enjoy pretty unhindered pricing power, which means, excellent margins.
And I bet with that kind of volume, their costs per unit must drop quite a bit. Creates a really efficient operation.
Precisely. High volumes mean great economies of scale. Unit costs get minimized. Stars really are your high-flying darlings. They definitely need significant investment, though, to maintain that growth trajectory.
Okay. So they still need feeding.
Absolutely. But here's maybe the paradox or the key insight. They're not just about growth now. They're actually your future cash cows in training. The smart move isn't just to invest. It's to understand that the moment you stop feeding their growth, they don't just slow down. They often, they fall. They become fallen stars. And that creates a vacuum you ideally need to be already filling with new problem children you've nurtured.
That makes sense. It's a cycle. Which brings us neatly to the next quadrant then. The cash cows. What defines them for a company like Peak Ventures, and why are they so crucial?
Right, the cash cows. A cash cow has that high relative market share, but it's operating in a mature market, or maybe a low-growth one.
So stable, but not exactly rocketing anymore.
Exactly. For Peak Ventures, this might be their long-standing, really stable IT consulting division. It's been around, it's respected, has big clients.
Got it. And the name cash cow.
Yeah, the milking metaphor really fits here. They generate significant, often very predictable cash flows. Essentially, you're reaping the rewards from all the previous investments that built up their strong market share and distribution channels.
So they're the reliable income generators, the steady foundation of the business. But if the market isn't growing much, what's the strategic play for Peak Ventures with these cash cows? Just milk them.
Pretty much. The strategic implication is really to focus intensely on maintaining and protecting their existing position. And alongside that, rigorous cost management.
Okay. Not really investing for more growth.
Generally, no. There's little likelihood of achieving significant new growth. Their main job is to generate that cash. They effectively fund the hungry problem children and the demanding stars.
Right. They allow Peak Ventures to chase future growth while having this stable base.
Exactly. They provide the fuel for innovation elsewhere.
Okay. And finally, the quadrant that often gets, a bit of a bad rap, but as you hinted, maybe it's often misunderstood. The dogs.
Yes, the dogs. These are products with relatively low market share, and they're stuck in a mature or low-growth market.
So low share, low growth. Sounds not great.
Well, on the surface, yeah. For Peak Ventures, maybe this is an older software product they still support, but it's been largely overtaken by newer tech.
Okay. And financially?
They might be loss-making. They could even have negative cash flow. And the common belief, often a bit simplistic, is that you should just, discontinue these. Cut your losses.
But you're saying that's not always the smartest move. What's the nuance here for Peak Ventures? Why would they keep a dog?
You're right to question that. While, yes, discontinuation is common, dogs can actually be strategically retained. For several compelling reasons, actually.
Like what?
Well, Peak Ventures, for instance, might keep that older software product just to complete their overall service range.
Sure.
To make sure they remain a kind of one-stop shop for certain clients, so they don't lose customers who need that full ecosystem.
Okay. So it supports other products indirectly.
It can, yes.
Yeah.
Or a dog might just provide a credible market presence in a certain area.
Oh.
Or sometimes retaining it helps reduce the threat from competitors. Maintaining a broad portfolio can sometimes deter rivals. And it's also worth noting, sometimes businesses find they have a lot of dogs simply because they've been starved of development funding in the past. It's not necessarily that the products were always destined to be dogs.
Right. So it's not always a failure category. Sometimes it's, strategically necessary or a result of past decisions.
Exactly. Vital is maybe too strong sometimes, but certainly strategically useful in specific contexts.
Okay, this is where it gets really interesting for me. Because while this framework is clearly useful, super insightful, it's not without its caveats, right? It's not some kind of silver bullet.
No. Absolutely not. And if we connect this to the bigger picture, the popularity of the matrix has faded a bit over the years.
Oh, why is that?
Well, partly because its core criteria, just market share and market growth, they aren't always reliable long-term predictors of success, at least not on their own. It can be, frankly, overly simplistic.
Oversimplification. Okay, that seems like a key criticism. What are some of the other specific limitations? If Peak Ventures relies only on the BCG Matrix, where might they trip up?
Well, for one, like we said, market growth is just one aspect of how attractive an industry is, and relative market share is just one measure of competitive advantage.
Right.
The matrix pretty much ignores a whole host of other critical factors that drive profitability. Things like, brand loyalty or maybe unique technology or regulatory hurdles that keep competitors out.
Okay, so it misses a lot of nuance.
It can, yeah. Second, there are real practical difficulties in just defining what high and low actually mean.
Yeah, for growth and share.
Exactly.
Yeah.
What counts as high growth in a, sleepy niche market is totally different from what high means in some global hyper-competitive tech space. Those lines on the chart can feel pretty arbitrary if you're not careful.
I can definitely see that. Context is everything.
It is. Also, its intense focus on high market growth can lead companies like Peak Ventures to maybe overlook significant profit potential in markets that seem to be declining.
Or abandon products that aren't growing but are still really profitable and loved by a core group of customers.
Precisely. That happens. And another big one is the independence assumption. The matrix basically assumes each business unit or product operates in isolation.
Which is rarely true in reality.
Almost never. It doesn't account for potential synergies. For example, maybe Peak Ventures' older dog software integrates perfectly with their new Star subscription service, making the whole package stronger for the customer. The matrix wouldn't show that linkage.
That's a huge point, that web of interdependencies between products and services.
Absolutely crucial. And related to that, while it can be powerful for looking at broad strategic business units, it's often less effective when you try to apply it to, say, individual products within a unit or very specific market segments. The nuances just get lost in that simple two-axis view.
Right, too granular for the model sometimes.
And finally, just to reiterate the point about dogs, because it's so often misunderstood, their position can be vital. Completing a range, market presence, competitor deterrence. These rules get missed if you just see dog and think divest.
Okay, so given all these limitations, what do organizations like Peak Ventures really need to consider when they use this matrix? How do they use it smartly?
Well, they definitely need to go beyond just plotting points on the chart. First, they have to think hard about how to reliably measure each category within their specific context. No cookie-cutter definitions.
Right. Make high and low meaningful for them.
Exactly. Then, critically, they need a plan for how to manage the identified categories. How do you leverage your stars? How do you fund your problem children? How do you manage your cows for cash? How do you strategically handle your dogs?
It's about the action plan after the plotting.
Precisely. And that includes figuring out what specific performance indicators, what metrics, are needed as a result of this categorization. And crucially, how those metrics link back to overall company goals and even individual performance targets. It's not just about labeling, it's about driving informed action.
So what does this all mean then for actually managing performance inside a company like Peak Ventures? You mentioned metrics. Is the BCG Matrix like a complete performance management system on its own? Or is it something else?
Yeah, that's a really important question. Is it truly a comprehensive performance management system, or is it more of maybe a diagnostic tool, a starting point?
Okay.
As a performance tool, it definitely has benefits, no doubt. It allows a company like Peak Ventures to see the different prospects of its various divisions side by side.
Gives you that portfolio view.
Exactly. And it really highlights the need for different management styles for each division. For instance, Peak Ventures high growth, star-like divisions. They're going to need more capital investment. They might not actually generate cash very efficiently yet, even if they're growing fast.
Right, because they're reinvesting constantly.
Right. Whereas their slower growing cash cow divisions should be laser focused on cost control and maximizing cash generation. Different jobs, different metrics.
And you mentioned even the cash cows and dogs, if managed right, can still provide value as they're sort of run down.
Absolutely. Even cash cows and dogs can be, as the sources say, a rich source of cash as they are run down, if they're managed properly for that purpose.
Okay.
So the performance management systems, the metrics used by these different divisions, they absolutely should be adjusted to reflect this BCG analysis. For Peak Ventures, maybe the metrics for that experimental AI app are all about customer acquisition rates and market penetration.
Yeah, potential over immediate profit.
While their stable IT consulting division would be measured much more on profit margins and predictable cash flow.
Okay, that makes sense. Tailoring the measurement. But it's clearly not the whole picture for performance management. What are its limitations specifically in that role?
Yeah, you're right. It has some significant limitations as a performance system. Firstly, it's just a very simple method of analysis, fundamentally. That sort of arbitrary 1.0 cutoff for relative market share, the line between large and small. It often means they can technically only be one star or one cash cow per defined market, which is often a massive oversimplification for companies with diverse, complex portfolios.
Yeah, reality is messier than that.
Much messier. Also, remember its origins. It was designed primarily for product portfolio analysis, for strategic planning, not really built from the ground up for performance measurement day to day.
So trying to kind of retrofit it as a primary performance system might cause issues, maybe sideline traditional metrics people care about.
Precisely. If you lean on it too heavily for performance evaluation, it might inadvertently downgrade really important traditional measures like, profit and shareholder wealth.
Which might not align with what key stakeholders like investors are actually focused on.
Exactly. It really should be seen as that diagnostic tool, a great starting point for strategic conversations, but definitely not the final word on overall company or divisional performance.
Okay.
Plus, there's the issue of internal variation we touched on. You might have different products within a larger business unit that just don't fit the unit's overall label.
Right, like Peak Ventures having a new high-growth mobile game inside their older, maybe dog-classified desktop software division.
Perfect example. Applying a dog management style and metrics there would be totally wrong. It would stifle that potential star.
Yeah, you can't just slap one label on a whole division if it's got fundamentally different things going on inside it.
Absolutely not. And then there are practical issues too, like how do you even clearly distinguish sectors from each other sometimes? Is Peak Ventures' content streaming service different from its live event division? If both are selling entertainment experiences, the lines can blur.
Yeah, defining the market itself can be tricky.
Very. And finally, back to that crucial point about interdependencies, it generally fails to consider the vital connections between business units. That dog software might be the essential backend for a star service.
Right. So judging it in isolation on the matrix is misleading from a performance perspective. It might look like a failure, but be enabling a success.
Exactly. Those inter-unit links are critical for any holistic performance management system. The BCG Matrix, on its own, often misses them.
Wow, okay. So we've really taken a deep dive into the Boston Consulting Group matrix today. We've gone beyond just the definitions, I think, to get a feel for its strategic power, but also its real-world limits.
Yeah, it's a tool with context.
We've looked at the core idea, those two key axes, market share, market growth, and we've really tried to unpack those four quadrants, the high potential, high-risk problem children, the high-flying, demanding stars, the reliable, cash-generating cash cows, and those often misunderstood dogs. We've seen how it really pushes you to ask deeper questions about your portfolios, your business units, but also, crucially, why it's more of a starting point for performance management, definitely not the final answer.
Well put.
I guess the big takeaway here is that, no single model is ever perfect, is it? But the BCG Matrix, even with all those caveats we discussed, it still provides this incredibly useful framework, a powerful mental model, maybe, for assessment and for sparking strategic thinking.
Yeah, it forces clarity.
Yeah.
Helps you decide where to potentially double down, where to hold steady, and maybe where to rethink things entirely.
Absolutely. So here's a thought for you listening to really sort of own this knowledge we've discussed. Think about how this matrix might apply beyond just traditional business.
Interesting angle.
Yeah, like think about your own skill set or maybe projects you're working on right now. Can you identify any problem children in your work life that need careful nurturing? Any stars that deserve more investment, more of your time to keep their momentum?
Maybe some cash cows that provide stability.
Exactly. Those skills or projects that are reliable, that fund your other ventures, or even any dogs things you're not growing, but maybe you keep strategically for a broader purpose.
Yeah, like a skill you maintain just to be well-rounded.
Right. And taking it one step further, what other factors beyond just share and growth would you want to add to your own strategic assessment framework? What else matters to you when deciding where to focus? Keep asking those questions. Keep exploring. Keep learning.